This is Taking Stock on Bloomberg. I'm Pimm Fox. Are shipping stocks a market hotspot right now? Well, my next guest says maybe. Natasha Boyden follows the industry for Cantor Fitzgerald. Natasha is a top-ranked analyst on numerous stocks, including Excel Maritime, Navios Maritime, as well as Free Seas. Natasha, good to have you with us on Bloomberg. It's been a while. So give us an update. Let's start with the tanker market right now. What's going on with the tanker industry? Are we seeing rates? Because there's a seasonality to it. The fourth quarter typically weak, right?
Well, no, actually, usually the fourth quarter is typically the strongest.
It's the strongest one, I beg your pardon.
One of the strongest because of the seasonality, the cold weather, more demand for heating fuel, that sort of thing. But, you know, we really have, in the last week or so, we've seen a slight tick up in rates, but nothing like we really wanted to see. And we're quite concerned about that because, you know, what we have seen over the last few months is floating storage has really dwindled to very, very few ships out there being used for floating storage. And we've just had a lot of ships coming on from the new builds, and that's really been swamping the market. And demand has not been, you know, as strong as we would like to see. So tankers have not been faring that well. All
right, well, let's talk about storage for just a second. I mean, is this because the investors or whoever was storing the oil in these floating tankers got the price that they wanted? Because we did see an increase in the price of oil, almost, you know, $90 a barrel.
Right. Well, what it is the contango left the market. And contango is when the future oil price is higher than the current oil price. So back 6 months ago, 7 months ago, the contango price was much higher than the actual price. So what happened is a lot of investors went to store oil on tankers in the hopes that they could sell it later when the price went up. That's happened, so we've seen a real dwindling of that floating storage because there is no more contango in the market. There's no reason to hold on to it to sell it at a later date.
And the demand issue that you described going into that seasonally strong fourth quarter, the demand you don't see as robust because what? Robust. Global economic growth and demand for refined product is down?
Yeah, I mean, certainly the US has been very weak, and so in Europe to some extent. I mean, China's really been the kind of the beacon, I suppose, for the industry. But what we've been seeing is a lot of cargoes going from the Middle East to China and not to the West, and that's a shorter journey. So that takes out ton miles. So that's really been causing some problems as well.
All right. So what about one of the companies that I know you're following, which is DHT? Why like the stock?
I like it. We like it because it's got very long-term charters. Therefore, it's not exposed to the whims and vagaries of the spot market, which we think is going to be, you know, fairly weak over the next 12 months or so. They have nice long-term charters. They have a new management team in who is really focused on turning the company into a real ship operating company, as opposed to previously it was more of a leasing company with only one end user, and that was OSG. And now they're looking to, you know, diversify out and have more charterers, end users. And it's also got a nice dividend. It's got about a 10% yield, and with those charters attached to it, we think they can comfortably pay that.
All right, so you like the idea that they've got these contracts and they're kind of set for a while right now.
Exactly. They're not exposed to what we see as being a weaker market going forward.
All right, so now let's shift and talk about what's going on in the bulk carriers. These are the ships that carry corn and iron ore and grain and coal and things like that. What is the dry bulk market like?
Well, I think it's a tale of two sectors, actually. It's what's going on in the Cape-size market and what's going on in sub-Cape-size markets. And the Capes aren't really doing that well. There's some issues with iron ore imports into China. They're down about 13% month over month, which is certainly not a good thing. The government has been looking to slow down their steel production, so we've seen some of the smaller mills being shuttered, which is certainly having an impact. And then there's the concern that inflation in China is going to lead to increase in interest rates, which is going to have an impact on economic growth and therefore, you know, potentially have an impact on commodity demand. And the Capes are pretty much exposed to China. That's their single end market.
And the Cape-size being the ships that travel around the Cape in South Africa.
Yes, Cape Good Hope, exactly. But they're exposed to China. That's their primary market. So, you know, we do have some concerns that, you know, should China slow down, which, you know, there is a good possibility, the Capes are going to be impacted quite severely.
So why do you like some of the stocks? I know that DHT tanker, that was an exception because of the long charter book. What about Excel Maritime, for example?
Well, we like Excel Maritime because they actually are in the smaller vessels.
Right.
And as I was saying, there's sort of a bifurcation between the two sectors. They are in the smaller Panamax, Kamsarmax segment, and we're seeing much more robust demand for those segments. Coal imports into India are up 20% year over year, and the forecast is very strong. There's seasonal imports into China and robust electricity demand. So coal there is certainly a very nice commodity to be in right now. And then there's grain. And grain grain has certainly been positive, mainly due to the fires in Russia, which have caused a wheat export ban, and that has resulted in some of the importing countries like Egypt having to source their grain from further away.
All right, so you took Excel Maritime. What about Diana? I know you follow Diana as well.
Diana, again, we like because they are pretty much I would say, in terms of their balance sheet, the strongest in the industry. They have
not a lot of debt, about 300 million?
They have, well, yeah, about that, but they also have almost 400 million in cash. They're fully time chartered out, so and they really are working on a growth strategy to build the company, and they have the funds to do that with. So we think that's a secure, solid investment for people to look into.
It sounds like the theme that you're working on is the companies have to have good balance sheets, yes, but also they've got to have contracts that go out a ways, right, because you're worried about what's going to happen in the short term.
We are. That's exactly right. That's
so you're going to see increased volatility in these trading?
I think so. I think we're certainly going to see, especially if the whole China thing comes to fruition and you start seeing China, their demand decreasing a little bit. That's certainly going to cause a lot of volatility in terms of global demand for commodities. And, you know, with the new pricing system, which is now a quarterly system for iron ore instead of an annual system, it just enhances the volatility even more.
All right. I want to thank you very much, Natasha Boyden, shedding some light on what's going on in the shipping industry, both the tanker and the dry bulk sector. Thank you, as always.
Thank you.